Okay, it's officially noon. I can see we have 51 attendees currently. So for everyone who's joined, appreciate you registering and getting signed in here on time. I'm going to give a couple more minutes for folks who might just be getting into the application before we go ahead and get things started. So just sit tight for another couple minutes, and then we'll start with introductions, and we'll get the presentation underway. Okay, so hopefully everyone can hear me okay. Just good afternoon. I think for some of you who might be dialing in from the Pacific time zone or Central time zone, I guess technically it's still morning. And for our international colleagues and peers, whatever time it is, good that time for you. Welcome to, this is the second of our three-part webinar series on catastrophe risk management. The webinar series has been sponsored by the Meteorology Alumni of Penn State's Weather Risk Alumni Society. And this is in partnership with the International Society for Catastrophe Managers, that's the ISCM. My name is Brian Bastian. I'm the president and founder of the Penn State Weather Risk Alumni Society, and I'll also be today's moderator. The presentation today will be focused on, as you can see on the first slide here, understanding catastrophe risk models. And our presenter today is going to be Mark Bove. Mark is a senior research meteorologist in the Risk Accumulation Department of Munich Re America, where his responsibilities include evaluating commercially available catastrophe risk models and providing technical expertise on underwriting and risk accumulation issues. Mark has been active in the meteorological consulting and research community for 20 years. Before joining Munich Re America in July 2000, Mark was a graduate research assistant at Florida State University in Tallahassee, Florida, where he conducted research on short-term climate variations and probabilistic modeling of extreme weather events. Mark holds a master's and a bachelor's degree in meteorology from Florida State and has earned the Chartered Property Casualty Underwriter, CPCU, and Associate in Reinsurance Professional designations. Mark is also a member of the American Meteorological Society, AMS, and the International Society of Catastrophe Managers, ISCM. Now, before I hand things over to Mark, just a note, just like in the first part, for those who were able to attend the first part of our series, that you can use the Q&A feature within the Zoom application to feel free to ask any questions throughout the presentation. We will have some time at the end of Mark's presentation to go ahead and have a live Q&A session. So as the moderator, I'm going to do my best to capture as many of those questions live as I can. If it's something that I can answer on the fly while Mark is presenting, I'll do my best to do so. Otherwise, we'll hold off on answering those until the end. You can choose to submit your questions either with your name or anonymously as well. So we definitely encourage everybody to ask questions. So without further ado, take it away, Mark.
Sure. Thank you, Brian. Thank you, everyone, for attending today, and to the Penn State Weather Risk Alumni Association and ISCM for setting this up. As Brian said, my name is Mark Bove. I'm a meteorologist with Munich Re America, and I have been with the organization for 17 years now. And today, what I'd like to go through is talking and to give you guys a better understanding of catastrophe risk models and how they're built and how they're used within the insurance and reinsurance industry. So, for today's talk, I want to give a brief review of what we talked about last time with Brian and Kim, and go over a couple of the key ideas and terms that are going to be repeated here today. Also, good catch up just in case you did not see the first presentation, so you're up on some of the lingo. Then, through the rest of the presentation, I want to go through a little bit about the relationship between insurance, reinsurance, and natural catastrophes. Then go into why did catastrophe risk models develop, and then how are they built currently and how they're ultimately used. And ultimately, we'll have plenty of time for Q&A at the end. So without further ado, I'd like to go back and review a few things that we talked about last time. First, I want to revisit a couple of the definitions that Brian and Kim gave. First is difference between peril, hazard, and risk. So peril, you can think about is the cause of the loss or damage. So we're talking about the large scale event, whether it's earthquake or windstorm, or like tropical cyclone or severe convective storm events. The hazard itself is the danger from the peril. So if you're worried about modeling the peril of tropical cyclone, you're really talking about modeling the two key hazards that result from tropical cyclones, which are the winds and the storm surge. Finally, the term risk can have two meanings. One is what is the potential for an adverse outcome? And the other one, which will be used commonly throughout this presentation, is a shorthand for any insured object. And in this conversation, we'll be talking about insured properties. Also, I want to remind people of what the purpose of catastrophe risk management is. And this isn't even exclusive to insurers and reinsurers. It can apply to any type of business that is exposed to some type of natural catastrophe risk. You need to identify the risk in the context of whatever organization you're looking for, and then need some way to quantify and measure that risk. And then once you have some metrics around what your risk is, you can finally make a decision based on the data, given the level of risk to your organization and how willing your organization is to either accept some of the risk or is more adverse and wants to transfer most of the risk away. And of course, this is a continual process, and anyone with any company with natural catastrophe exposure will continually monitor their exposure to the risk and how it changes with time. Now, the role of catastrophe manager is many, and this was a slide that I borrowed from Brian and Kim last time, showing you the range of responsibilities and roles that a catastrophe risk manager plays. Now, really, I'm only going to be talking about CAT modeling here, but I want to emphasize the importance of CAT modeling on every single role that is featured here. In fact, if my PowerPoint presentation skills were better, I would have redone this image as an arch with the CAT modeling as a keystone that helps support everything else in place. As in a keystone in an arch, you remove that, everything else below it crumbles. And you can kind of think of CAT models of that keystone of the modern role of the catastrophe manager. It literally does influence every other role here and is a critical and integral part of making decisions within this role in the industry. Last thing that I want to review is how insurance overall is priced. Now, covered this last time, your typical goods you get at the supermarket, the costs of producing those items are well known and usually fairly fixed. So, there can be some fluctuations here or there, but really there's little uncertainty in price and how much profit the companies that produce these items make, as well as the distributors that help get their products to market. This is not really how insurance works, because insurance policies are essentially promises that in return for premiums that are given to the insurance company, they give you a promise to pay in the future if you suffer an unforeseen loss, and are willing to indemnify you to get you back to where you were before that loss occurred. However, there's a lot of uncertainty. If you're looking at auto insurance, what is the expectation that you might be involved in a collision? Even with a good driving record, there's always a potential that you might be in a collision. And, insurance policies need to reflect this uncertainty in the final cost. But also, there are two issues that make insurance pricing for catastrophes a little bit more challenging. One is a lack of historical loss data, and the second is that catastrophes end up damaging a lot of risks and properties at once. And with that, I want to give some examples and talk about the relationship between natural catastrophes and the insurance and reinsurance industry. And I would like to start off by sharing kind of a dirty little secret about insurance and natural catastrophes. It might not be that dirty, but a lot of people don't realize that this is the case. But primary insurance, the type of insurance you buy for your auto or home from your State Farms, your Allstates, whatever primary insurer you contact, really that product is not well suited to handle natural catastrophes. And really, that's where reinsurance steps in, and reinsurance really becomes the true social financial risk transfer mechanism for very large catastrophic loss events like we've suffered this year in Florida and along the Gulf Coast. And let me give you an example why this is the case. So here's a map of southern Florida, and let's assume that in this case, it is a world without insurance. So the financial instrument was never invented, but people are still moving to South Florida. They like the weather and the climate. And say there's a gentleman who builds a home somewhere in southern Miami-Dade County. And let's further assume that this house is worth $500,000. So what happens if his home burns down is that he is on the hook for whatever it costs to rebuild. So if the home costs $500,000 to rebuild, he has to, out of pocket, once again, pay fully to rebuild his house. Now, most people to build a $500,000 house or any cost has to take out a mortgage to cover it. So they probably don't have all the money up front to build the house the first time, let alone a second time. So in this world without insurance, we could hypothesize that he has a friend a little ways away, say, and has a house worth the same amount and says, listen, I'll make you a deal. If your house burns down, I'll share the cost to rebuild with you. And if my house burns down, I will share the cost with you. And in this case, if these two guys or people agree to it, their cost to rebuild per person would be only $250,000 each. And now say they think they got in on a good deal. They tell a couple of other friends. 8 other friends decide to get in on it along in South Florida. And if they all go in, the cost to rebuild if one of them loses their house is only $50K per person. And you can see how this progression is going to go. If we expand this out to 100 risks, if only one of these homes burns down, the cost to rebuild per person is $5,000, a much more manageable amount for everyone. And this is how primary insurance ultimately works. It takes a lot of risk, and those premiums that you put into your company go to pay out losses for people who are unfortunate to have to damage or their homes burned down. So, and this is why we pay premiums every year for perils like home fires or any other type of home damage, water damage from pipes bursting. There's a lot of good data that they can base these prices upon. However, for natural catastrophes, this really fails because insurance products are not really designed to handle many claims at once. They're more for the infrequent claims like fire or pipes bursting. So let's say in this case, we have a hurricane, and note my very sophisticated animation, go through South Florida, and it totally destroyed 30 of these 100 buildings that have kind of joined together in a pool. If 30 of these homes are destroyed and they're all $500,000 apiece, this would cost $15 million to rebuild for this group. If they collected $5K from each person every year, it would take them 30 years to even have this amount to pay back out. And this is let alone if you consider this agglomeration of people as an insurance company, you have to think they have also expenses for their offices, their staff, for salaries and other things. So most insurance companies in a situation like this would not have the $15 million around to pay for these claims just because of their normal day-to-day activities. So insurance really does not do a good job of handling the large natural catastrophes where a lot of locations are impacted at once. And this is really where reinsurance comes in. It helps keep these insurance companies in business after disaster by transferring all or a portion of these risks to a reinsurance company. This gives them coverage so they can make sure they pay their claims, but also in the broader sense, it helps diversify the risk because the reinsurance company might have this insurance company A in Florida that was impacted as a client, but they have dozens of other companies that might be writing exclusively in other states that aren't impacted that help diversify the reinsurance company's risk and help them remain solvent. Furthermore, a single primary insurance company, their reinsurance coverage may be participated on by dozens of different reinsurers around the globe, which ultimately helps spread the risk and the potential losses associated with them around the world, thus making these loss events much more manageable to both the individual communities who have better coverage and are likely to get money pumped back into their communities faster, and also make sure that financial tractions and areas around the world are all covered. So with that, the other issue that insurance has is there's really very little historical claims data for which insurance companies and reinsurance companies to assess what their true risk is due to natural disasters. For hurricane in the United States, we've had a lot of activity this year, but for some perils like earthquake, we really don't have any good loss experience or information on the activity in California since 1994 in the case of Northridge. So there's a lot of cases we don't have a lot of good data, so it's hard to understand what the correct price is, particularly before the advent of computers, and this is the informational gap that catastrophe risk models actually filled. So ultimately, after all that, what is a catastrophe loss model? Simply, they are computer programs that estimate the financial impacts of a given peril to a single risk or a collection, or what we call a portfolio of risks. Catastrophe risk models use pre-compiled stochastic event sets to calculate the financial losses to a risk based upon really three key factors. One, what is the event intensity at the site of interest? The risk's physical characteristics, and third, the terms of the financial contracts in place. Let me give a little more detail by stealing one of the slides from last time. What are CAT models and what are they not? First of all, they are not predictive. As I mentioned, these are all pre-compiled event sets of hypothetical storms that might occur in the future. So we are not doing on-the-fly predictive modeling, though there are some functionalities with some models to do deterministic events if we are expecting a landfall. Most of these models are still heavily statistics-based, though we will see numerical weather prediction models informing them more and more, and I will highlight areas where that occurs in the presentation today. Furthermore, every CAT model makes different assumptions, whether it's regard to the frequency or severity of landfalls along the coast, what is the likelihood of a magnitude 8 earthquake in San Francisco, what is the vulnerability of wood frame single-family dwelling construction in a given state. All these companies have incomplete data and ultimately have to make these assumptions using their best engineering and meteorological knowledge to set it, and they could vastly differ from company to company, even though they are attempting to solve the same problem. So multiple solutions, and not necessarily, and none of them are correct, and all of them could be legitimate solutions to what might happen. Lastly, cat loss models now allow for user-defined views of risk. This used to be different in the past. The models used to be more rigid and set up by the modeling companies. You would put in your data, run the model, and you would get one answer out based on the data that you input. That has changed today. There are a lot more knobs and buttons within the catastrophe risk models that allow users for different defined views of risk. One example might be turning off and on storm surge, depending if you're actually insuring storm surge related risk. There are different views of frequency intensity of tropical cyclones in the Atlantic, conditioned either by predominantly by Atlantic multi-decadal oscillation warm phase. And then, of course, there's secondary perils like fire following earthquake that you can model or not. So I'd like to go back and give a little bit of history of these models, because as I mentioned, for a long time in insurance history, there really was a gap of effective tools to understand the frequency, severity, and loss potentials from natural catastrophes. So back in the Stone Ages in the 1980s, really before the PCA age, the reinsurance industry lacked any functional usable risk accumulation information. And essentially what individual underwriters did, or agents at their desks or behind their desks, they'd have a map on a cork board, and they would use push pins to identify where their risks are in a given location. Now, of course, this isn't very portable and difficult to aggregate up. So most insurance companies in the 1980s really did not have any true sense of what their accumulations of exposure were in certain areas that are highly exposed to natural catastrophe risk, including South Florida and Miami shown here. So in around 1985, an actuary by the name of Karen Clark, who is still very active in the industry, said, we can solve this problem. And she took an actuarial and engineering approach to this issue, combined with some meteorology, and came up with the first US hurricane model. And when she published her paper on this model in the mid-1980s, the insurance industry almost laughed at her. Because what her model was showing was that multi-billion-dollar loss events were likely in South Florida. And people just did not believe it. They said there's no way that a storm is going to cause this magnitude level of loss at any time, even in Miami. And that was the prevailing view in the industry really until a couple of months before the 1990s started. And for this slide, I'm starting the 1990s as of September 1989, because in that month, they were two major events within 1 week of each other in the United States. The first was the Loma Prieta earthquake in 1989 that caused significant damage in the harbor or in San Francisco, particularly with the fires afterwards, and of course the famous collapse of one of the segments on the Bay Bridge. Insured losses from this event at the time were a little over $1 billion in the Bay Area in California. Less than a week later, Category 4 Hurricane Hugo devastated Charleston, South Carolina, and as I mentioned, insurers didn't believe that a multi-billion-dollar loss event was possible at this time in Miami, let alone in South Carolina. So when Hugo caused an insured loss in 1989 of $4.5 billion, the insurance industry really started to take notice and was seeing that these models actually do have predictive skill. Then 3 years later, Hurricane Andrew did indeed devastate southern Florida and coastal Louisiana to the tune of $16.5 million in 1992 dollars. followed 2 years later by the Northridge earthquake in the Los Angeles area, which cost $12.5 billion. So suddenly, these models were shown to have skill. They were useful in both predicting what might happen and accumulating exposures, and these models became widespread accepted within the insurance industry. So by the start of the new century, the models were pretty much accepted, ingrained within the insurance and reinsurance world, and we saw the expansion and more options for these models. So of course, the biggest event for catastrophes, not necessarily man-made or not necessarily natural, was the 9/11 attacks in 2001. And you can model the physical properties of a terrorist attack as well, and modelers started to provide models to address this risk, both for conventional style attacks and also for the weapons of mass destruction, such as nuclear, biological, chemical, and radiological weapons. Also, early 2000s, we had the SARS outbreak, a couple worries about avian or swine flu, and models for pandemic also have started being developed for workers' compensation and life insurance purposes as well. Also, it was in the 2000s when these models started to get extra knobs and buttons within it, particularly after the 2004 and 2005 seasons, where we saw 12 hurricane landfalls in the United States. So modelers started saying, okay, we do see these more active and more quiet periods in the Atlantic, and depending on your view of the risk in the Atlantic, it might make sense for you to measure your risk to this more active warm phase period, or you might be okay with still going with the long-term average. And besides these different views for climate condition, they introduce other ways to sensitivity test models on the hazard itself and also the vulnerability components, which I'll talk about here in a little bit. Bringing CAT models up to today. Today, we're seeing a dramatic increase of numerical weather prediction modeling by model producers, particularly for storm surge for both tropical and extratropical cyclone. Statistical modeling and the resolution that you can do statistical modeling for wind is a little bit easier. For storm surge, you need such level model resolution precision to get accurate results that they really have no choice but to use NWP technology. Also, though most models, aside from storm surge, remain statistically based at the moment, the modeling firms have increased their use of reanalysis data and using physical models, such as the WRF model, to inform their statistical model development, particularly where little historical data are available. For example, modelers might use a dummy vortex in a WRF model to see over 1,000 times to see how extratropical transition of tropical cyclones in the northeast United States might look like, so they can inform their wind field model for actual purposes. Also, the customizability of these models have continued as well, and we even now have the development of open source plug-and-play modeling platforms. So there's a lot of modelers with all these options that want to be your one-stop source. They don't want you to buy multiple models to understand your risk. They want to be your one-stop source for all your needs. And now also with the amount of data that is being introduced, these models are moving to the cloud to improve the model run capability, resolution, analytics, and so on. So the major vendors in the market are listed here on this slide. This is obviously not comprehensive, but these are some of the major players in the market. RMS, AIR, CoreLogic, CatRisk are pretty much all pure catastrophe risk modeling vendors. Aon is a insurance reinsurance broker who also has a model development unit called Impact Forecasting that's also very active within the industry. This is not exhaustive. Several large reinsurers, including my own company, Munich Re, develop some CAT models for some areas of the globe. And also what I want to talk about as I now transition from talking about the history of these models to how they actually operate, I want to note that the methodology concepts that I'm going to be showing over the rest of this presentation are not based upon or exclusive to any individual modeler. So I am going to be providing the general steps and questions that each modeler has to ask themselves while they're developing a catastrophe risk model. And so some people will have different answers, some will have different approximations, but in general, this is the process that all these companies, regardless of what their final decisions are, will take. And lastly, I just want to also mention that, forgive me, I'll just go on because for some reason I just blanked on my point. I'm sure it'll come back to me. I apologize. So there are 4 basic building blocks to all catastrophe risk models, regardless of whatever peril that you're modeling. And they are listed here: the stochastic event set, the intensity calculation, damage estimation, and finally, loss evaluation. Now, you'll see sometimes in the industry, these 4 components are grouped together in a different way. You might see the stochastic event set and the intensity calculation all grouped together into what we call the hazard module of the CAT risk model itself. Similarly, you might hear the damage estimation component be called the vulnerability module, and the loss evaluation to be the financial module. Each is a different piece of the model that plug into each other to get your results. So let's take a little bit deeper look into each of these 4 building blocks of CAT models. And what I was going to say that I totally forgot before is this talk is about the basics of all catastrophe risk models in general. I know we have a meteorologist-heavy audience here today, so I do have a little bit extra information of how tropical cyclone models are built, but ultimately I will have a recommendation if you really want to go more into detail of how some of the weather-related CAT risk models are built. I do have a couple of links for you guys for resources that you can look at your own time. So the stochastic event set, the first component, is a set of discrete events covering all the important combination of location, size, and other characteristics of the peril in question, as well as the probability of that event occurring. So the event sets of CAT risk models have several objectives that they need to meet. First one is they have to account for all locations that are impacted by the peril of interest. And my shorthand for this is, if you're building a tropical cyclone model, you definitely want it to include the state of Florida, but you don't need it to cover the state of North Dakota. So figure out your domain that you need to cover by all the events in your event set. Second, you have to have a sufficient number of events to cover all possible size and intensities that are possible at a given location. So CAT risk models operate on the law of large numbers, and you need a sufficient number of events to get your financial results to converge for a given risk or portfolio of risk. So this is why you'll see event sets that have anywhere between tens of thousands to hundreds of thousands of events contained in them to make sure that they have a sufficient number. And of course, you don't necessarily need all permutations of size, shape, intensity at every location. Does it make sense to have tropical cyclones as weak as tropical storms to Category 5 impacting South Florida in your model? Of course. But do you need that full range all the way up to Cat 5? Along the coast of Maine? Maybe, maybe not. That's one of the decisions that your engineers and scientists would have to make when building your model. As I mentioned, the model has to consider the probability of a given event occurring because insurance contracts are typically on an annual basis. So the models need to give us the annual probability of one of the given events actually occurring. And models take the historical rates and divide it by the stochastic event sets of like location of landfall and intensity to try to determine those probabilities. Lastly, the event set has to have enough events in it to produce loss results that are geographically consistent and statistically stable. And these comments are kind of linked. When I talk about geographically consistent, let us assume that we collectively own a beach house in Miami Beach, and that our friend has a similar beach house, same build, construction, value, everything, about 30 miles to the north in Fort Lauderdale. So what is really the difference in hurricane hazard if you're both on the beach, one in Miami Beach, one in Fort Lauderdale? Really, the difference in tropical cyclone hazard between those two locations is very small, not zero. Miami arguably has a bit more, but there is a difference, but it's very minor. So we want to make sure that when we look at these two locations in a tropical cyclone model, that their results still are relatively similar. If we see tropical cyclone losses to the same risk, just 20 miles apart, that are drastically different, particularly if they're both right along the coast and not inland where friction has an effect, then something is going wrong, because the long-term view of risk between hurricane risk in Miami and Fort Lauderdale is almost nothing. Lastly, I mentioned before, you need to have enough events that your results are statistically stable, because if you do not have enough events, some of the financial output we come out would change dramatically if you just added one more forgive me, additional event on top of where your risk is. So eventually you add enough events that all your statistics are going to stabilize, and that is critically important to how these models work. The second building block of cat risk models is the intensity calculation. So this really goes in tandem with the event set generation. It's easier to talk about it by separating it out, but as I mentioned, this is often combined with event set generation into the hazard module. So the models have to calculate the intensity of each event in the event site that at every risk or site of interest that is impacted by that event from the stochastic event set. So if you have an event set of 10,000 events, you have a portfolio. For every portfolio risk in your portfolio that is affected by an event, the intensity has to be calculated. So how is the intensity at each location in your portfolio calculated? Well, it's based on the established physics of the hazard being modeled, and it has to also consider the source, path, and site characteristics around your risk to determine what the intensity actually is. You can consider source characteristics as the intensity of the tropical cyclone itself. That would be a good example of how the intensity is influenced by the event itself. However, path characteristics could be whether you're on the strong side or weak side of the tropical cyclone with respect to forward motion. That also has to be modeled and be considered. And lastly, you have to deal with the local environmental influences at and around your site of interest. So for the model to do these intensity calculations, the model requires a little bit more information about where the risks are located and what the environments are around your risk. So to do this, the models include a geocoding engine and what we call geospatial hazard databases. So geocoding, I'm going to guess that most people are quite familiar with this now. It's just a computer program that transforms address information into latitude, longitude coordinates. And here's a brief example for Beaver Stadium and University Park. And you put in that address, you'll get out that longitude. And most of the geocoders will get you within roughly 10 meters of the property with today's better geocoders, if not better. The second piece are geospatial hazard databases. So this is information on the local environmental factors that influence event intensity at a given risk location. So with tropical cyclone wind, obviously it's going to be topography and surface roughness that influence. And here is a surf land use map of Florida. And of course, the roughness lengths that affect the wind speeds at any location will be affected by the surface roughness. And of course, the direction of the wind and fetch upwind of a given risk, not just the immediate local area, is also considered in determining the intensity at a given site. I want to give a brief example for the meteorologist in the office using Atlantic hurricane event set development as an example. All CAT modelers use the same initial database to develop their event sets, their statistical models for tropical cyclone. All of them are using best track data from NOAA as their first order source in calibrating the frequency and severity of landfalling tropical cyclones in the Atlantic, Caribbean, Central America, and Mexico as well. It's not just US centric, but they're getting parameters for everywhere that's impacted by Atlantic tropical cyclones. So they also use best track data to extract dozens of different parameters from the historical record for statistical modeling. Some examples might be direction of motion over a certain area of the ocean, speed of motion over a given latitude, longitude box over the ocean, so on and so forth. So with creating the event set itself, there's a couple of primary methodologies that are used by the model vendors. Going a little bit more out of style, but is still used to some extent, more so in earthquake, is the event tree approach. For hurricane, it would be defined as modeling a range of hurricane parameters, which I mean different combination of intensity, angle of landfall, radius of maximum winds, and so on, at thousands of predefined points along the U.S. coastline without caring about what happens in the open ocean. The only thing that really is conserved is the landfall rates for a given intensity along the coastline. So you can think of this, say you can have a point just off the U.S. coastline from Texas to Maine in every 5 miles or so, or 10 kilometers. And at each point you can say, okay, I'll model a tropical cyclone going in with sustained winds of 55 miles per hour and 65, 75, 85, all the way up to what you feel theoretical maxes in that area. Then for each of those wind speeds, you might do a number of different angles of landfall, a number of different Rmaxes. And as you do this, and as long as you conserve the historical landfall rates, this is an acceptable approach to developing your events. However, particularly for meteorological perils, we're seeing more of full yearly simulation or basin simulation of events, whether it's NWP or statistically based models. So basin simulation is modeling the entire Atlantic to recreate realistic hurricane event sets using tens of thousands of model iterations or years. And of course, once again, the historical landfall frequency severity relationships along the coast, which we call gates, also must be closely approximated by the model. So these models do have to closely reflect what we've seen historically in the past. Though in areas of low history, you can fill in the gaps by looking at adjacent gates or expert opinion, trying to understand why there hasn't been as many landfalls in certain spots. In creating a tropical cyclone wind field, there's several different equation approximations that can be used, including any type of numerical weather prediction model, which uses the equations of motion of the atmosphere. You could just use the gradient wind equation or some kind of parameter or vortex. And all are legitimate. And remember, given the uncertainties within this model, we do not need exact high-level detail on the wind fields. But we do need a metric to relate the hazard intensity to damage, and that's usually done by using a 3-second gust, and also duration of the winds at a risk site might also be considered. Lastly, with tropical cyclone storm surge, numerical weather prediction is typically used. They're taking slosh out of the box from NOAA, or they might be modifying it a bit, or else they might be building a new NWP model in-house, or they might license a model from elsewhere, like one company licenses the Danish Mike 5 hydrological model for their source. And all of these those are typically how storm surge is modeled, and it's forced by us given stochastic events wind field. Now, as I said, I can't really get into full detail on how meteorological CAT models are built. However, the state of Florida requires all the model vendors that write residential business in or that want to be approved for rate making in Florida for homeowners insurance need to submit their models to a rigorous testing by the state of Florida. And all this information is public domain and is available on their website. So if you're really curious to going into the nuts and bolts of how these event sets are developed, I would highly recommend that you go to this website. And plenty of different years, you can see evolution. And right now, most of the methodology is on wind, but they are working on storm surge and flood standards for the state as well. Continuing on, the third building block is damage estimation. And this is a set of functions that relate the damage level of a structure, relate the intensity of an event at a given site to the damage state that will occur given its vulnerability to the particular peril and the event intensity at the site. So these damage functions, or vulnerability curves as we interchangeably call them, have to consider a building's main characteristics, such as what materials were used in its construction, what type of occupancy is in the building, year of construction, and so on. We call these in the industry the primary modifiers of the risk in question. These are the first order pieces of information about the risk, how the risk is built, and what it looks like. However, the model can also consider dozens of other building characteristics that might either improve or make worse its vulnerability to the peril in question. We call these secondary modifiers, and this might be information on whether your roof is a hip roof or gable roof. They have different vulnerabilities to wind. Whether you have wind-rated shingles or just regular 3-tab? Do you have hurricane shutters? Do you have hurricane straps? All those would be considered secondary modifiers to a risk. The model also need to consider building codes, the initial quality of the construction, as well as the age and maintenance of a building. So you'll see, particularly for building codes, different year built bands within the model that inform the model as to how good the building codes are were when a given risk was constructed. Also, there has to be different damage functions for each insurance coverage that is offered to the risk. So we don't just have one vulnerability curve for a given risk. 3 will be selected. One for the building itself, the structure. There'll be a separate vulnerability curve for the contents, and an extra one for the loss of use of the property, something we call time element, or if it's a business, we call it business interruption. So there are literally hundreds of different damage functions that are built into these models for these different coverages. So I talked about the consistent measure to relate event intensity with damage. For tropical cyclone, it's usually 3-second gust. And lastly, if you're covering secondary hazards like fire following earthquake or storm surge, you need separate vulnerability functions for them as well. And this is a very idealized example of what a vulnerability curve generation and calibration looks like. On the x-axis, we have 3-second wind gust, and on the y-axis, we have the mean damage factor to the house on a scale of 0 to 1. So a percentage damage factor, essentially. So what modelers do is take claims data from their clients. They have how much the policy was. They have the damage amount, the claims. Then they can use data records from the historical storms that they get claims data from and plot it on this chart. And eventually you have enough locations of a like construction occupancy that you can build a mean fit to these curves, also measure the uncertainty around it, and then ultimately input these into your model. So here we're relating intensity to the expected damage state of a building. And the last building block is the loss evaluation. Given the damage state to an individual or portfolio of risks, how do you apply the applicable insurance and reinsurance structures to those damage states? So ultimately, the financial module determines how to take building damage and translate it into insurance loss. This has to be done. It can be done for individual locations, for multi-location accounts, or for portfolios containing millions of individual risks. Loss evaluation also needs to know whether to or how to account for several different socioeconomic impacts that can influence what a loss is, an insurance claim is adjusted for. Some of these items include demand surge, which is an increase in the demand for materials and labor after a large cat event, which due to supply and demand could increase the cost of labor and the materials needed. Unfortunately, we also have people that, after a disaster will price gouge just because people will pay the price to get their homes repaired quickly. In some areas of the country, particularly with hail, we see aggressive contractors saying, hey, looks like you might have had some hail. Sign over your insurance claim to us. We'll get you a new roof. So there's a litany of other things. And even if this doesn't sound right, these things are actually happening in reality in the insurance market. And these curves do need to somehow consider these factors as well. So all cat loss models first calculate a financial perspective that we call ground up loss, which are losses that are applied before any insurance or reinsurance structures are applied. So if you look at the primary insurance example on the left, say you can think of this as a bucket. You can pour losses in, and as it goes up, it goes through different layers where different people are covering that loss. So a ground up loss, so say a loss got all the way up to the top line on primary insurance, if it got there, the ground up loss would be the sum all the way through from zero all the way up to that loss. However, once you start applying financial perspectives, you get different views. If we take out the deductible and any losses over the limit of the insurance policy, we get the insurer gross loss. And the sum of all insurer gross losses to all locations from a given event then get fed into their whatever reinsurance structure they have. They might have some retention here below. Everything in black here is kept by this hypothetical insurer. But they might have some per individual risk treaties as one layer. They might have multiple reinsurers participating on catastrophe excess layers and also co-participating on those layers as well. So they have some skin in the game, so to speak. And then there could be dozens of reinsurers on their corporate excess layer. And ultimately, this insurer needs to decide up to what limit are they going to buy coverage. And if losses go over that amount, what are they willing to retain above all their reinsurance? So these models have to calculate the losses to all these myriads of different financial perspectives, because this is the end product we're really trying to get to. So those are the four building blocks, and I wanted to show the model in a very simple flow chart. So in the red rectangles, we have the four building blocks that I've already discussed. And in the two bluish circles, I have the two additional databases, the geocoding engine and the geospatial databases that ultimately feed into how the intensity is calculated at each individual site of interest in your portfolio. Now, what do the modeling companies add to this? Within the exposure data we receive, we get information on the address of the risk. That goes into the geocoding engine and spatial hazard databases, which help determine the intensity at your site from each event in the event set. The information on your risk construction and occupancy go to select which damage functions are selected for your risk, each individual risk. And finally, the insurance and reinsurance structure get fed into the financial module to come up with all these losses. So this is a very simple view of how these models work. Let me give you a slightly more advanced one. So you can think of these models as they go through the event sets almost as a very large do loop, if you remember your coding. So we can start with the step one, the stochastic event set. We can say let x equals 1 and n is the number of events in the event set. So let's assume for this case n is equal to 1,000 events. So we go to event 1. So if say we have our Miami beach house again. So let's say event 1 impacts our Miami beach house, which means the intensity will be calculated, so we go to step 2. If not, we would just iterate to the next event, and the model only cares about the events that have loss that impact your portfolio. So if nothing is impacted, it'll skip it and go right to the next event. So let's assume that an event, this is actually a Harvey footprint, but let's go with it. So it'll look up the wind footprint. It knows your site. It has a precompiled intensity there. It'll calculate that intensity for your site. And of course, it's based on its location relative to where the storm was. Once you calculate the intensity, which is a 3-second gust, that gets fed into the damage estimation. So here in damage, the damage function, you have on the y-axis the intensity, damage factor, and the model looks up where on the vulnerability curve that intensity lies and obtains the mean damage for that risk from that wind speed. Once we have that, it gets passed to the loss evaluation module, and the ground up loss that I talked about, the first dollar ground up from the beginning, no insurance, is just equal to the damage factor calculated in step 3 times the value of the risk that you're dealing with. So say you have a $500,000 home on Miami Beach. The damage factor from this event is 0.2. You would take the ground up loss would be 500,000 times 0.2, which is $100,000. Once you have that ground up loss of $100,000, you can then apply your deductibles limit, so on and so forth, and start calculating your higher level financial losses. So all this is done for event 1. We go step 2, 3, and it keeps iterating. And remember, it doesn't matter if you have 1 risk or 1,000 risks. If a model impacts all 1,000 risks in your portfolio, the intensity has to be calculated at each individual location. So if you have a portfolio of millions of records in Florida and you have 8,000 events going through Florida, you can see how the outputs of these models get very large very fast. So what happens after we go through this massive loop and calculate location level losses for every event? Well, the models build what we call event loss tables, and they always start at the location level of the process of aggregating insured losses. Location coverages are the most finest resolution we can get information on. So for each of these, for each event, and here on the table, I have 10 events listed with a annual rate of occurrence assigned to it. And here we have hypothetical events for 2 policies, and each of these 2 policies cover 2 different locations. So you can see that the model is going to store the expected losses, which are shown here, and also information about the the standard deviation about it. So it'll do this for each location in your model for every event that impacts your portfolio of risks. Once you have the location level losses, the models can start aggregating to higher level financial perspectives, like the policy level and the portfolio level. So for doing the location level losses is relatively easy because we can assume that all the coverages at the location, building contents, time element, are perfectly correlated. However, once you start getting to multi-location policies, you do not have perfect correlations anymore. So you need to start considering what is the correlation of losses between different risks. Is there a higher correlation between risk in a tropical cyclone? If they're 1 mile apart, does it change if the risks are 5 miles apart, 100 miles apart? Those are questions that the modelers need to answer and might come up with different answers for. And then, of course, we need to apply different deductibles and limits at the level at which they apply. For example, for this event 2, the 2 locations under policy 2 create a total loss of $130,000. However, if you look at the policy losses in orange, policy 2 has a policy limit of $100,000. So only $100,000 gets passed through and is actually paid off on this risk, despite the losses being $130,000 in total. So the policy only pays out what is contractually obligated, and it'll do that calculation. Ultimately, once we have all the policy level losses, we can aggregate up and sum up to portfolio level losses. Now, once we have the portfolio level losses, the model creates what we call an annual loss distribution. This is really the foundation of what we call exceedance probability curves, or EP curves, which are the key output of CAP models. We call them annual because most contracts are for 1 year, so the loss distributions reflect this fact. So to create these loss distributions, you essentially sort the portfolio level event loss table by loss severity in descending order. So I've just taken in this table the portfolio losses you saw on the last slide, but just sorted them with descending loss. So after this is done, using the event rate information here, I have it labeled as frequency, which is not quite right. I apologize. You can then calculate the annualized loss distribution by evaluating the probability that the loss from any given event will exceed a certain loss threshold. So here, the largest loss is 120,000. This event has a rate of about 100,000 year return period, the reciprocal of this frequency, and that's it. We have an exceedance probability of 0.00001. So what is then the probability of losses exceeding 110,000? So in this case, we have two events that exceed that loss threshold. So in some extent, the exceedance probability frequencies or rates get summed together. That's not exactly precise on the mathematics, but it's good for this example. For 100,000, 3 events, so you sum up the 3 frequencies to get the exceedance probability, and you see how the return periods, which are the reciprocal of the exceedance probability, start dropping precipitatively as you go down and start adding up rate of exceeding a given loss threshold. Now you can plot this, and what we get is what we call the exceedance probability curve. This is the ultimate and most important financial output for these catastrophe risk models. They tell you the annual probability of or chance of losses exceeding a given threshold. So these, even though on the previous slide I talked at the portfolio level, they can be generated at the location or policy level as well, and can be applied to either single events or on an aggregate basis. So here is the EP curve. On the x-axis, we have insured losses increasing on the x-axis, probability of exceedance increasing on the y. So for very, very low losses, you see the probability of exceeding that level of loss is very high and goes ultimately up to 1. And then as the losses get higher, the probability of exceeding that level of loss drops quicker. So, and here you can see the reciprocal nature of return period and exceedance probability. So if you have a 1 in 100 year event, that would be n is 100, 1 over 100 is 0.1% probability of exceedance. And you look up that loss on the table and you get the 100-year loss, which would be at this point. Now, there are 2 different types of EP curves most commonly used within the industry. The first is an occurrence exceedance probability curve, which we call OEP curves. So this provides the probability that the maximum event loss from any given peril a year will exceed a given loss threshold. With occurrence, we're only worrying about the most severe loss in a given year. Now, when we're talking an aggregate EP curve or an AP, we want that curve provides us the probability that the sum of all event losses from a given peril in any year will exceed a given loss threshold. So let me give you an example of what this might look like if for somehow modeling firms actually modeled the 2017 hurricane season as part of their event sets. So if we looked at that and ran it across industry data, and these are actual current estimates for industry losses from the 4 hurricane landfalls this year. So imagine this was a modeled year within a model. How would this look and be reflected in the OEP and AEP curve? Well, for the OEP curve, we're only concerned about the largest single loss during the year. So for the United States, the OEP event from 2017 currently is Hurricane Maria with losses of $21.5 billion. The AEP loss for this year, if it was a modeled year, would be the sum of all U.S. hurricane losses, which here is 55.5. If I missed a weaker tropical cyclone from early in the year, forgive me, but you kind of get the point here. Now, obviously, Harvey came first. You might say, well, what happens if some of these policies pay out on Harvey, but then we have an Irma and Maria? Well, there are opportunities for occurrence-based reinsurance treaties to buy reinstatements as well later in the season if you do exhaust certain layers. So these are two very important views of the risk. And one other metric that comes out of these EP curves that's very important is what we call the average annual loss. This is a measurement of overall catastrophe risk to a portfolio or a single risk. And it is really what we would consider the very, very long-term average loss to an individual risk or a portfolio during a calendar year for a given peril. So you can think of this, say we had our Miami beach house for 10,000 years or 100,000 years. So the AAL would tell us is what we would expect as an average loss to our house each year over that 10,000 or 100,000 year time period. So most of those years, the loss is going to be zero, but in some of those years, it's going to be a spike. You might have a total loss on your house, and some years, some loss to it, not partial damage. So the AAL essentially is taking these long losses over a very long period of time on a risk and averaging them. We also call this metric loss cost or pure premium, because essentially it tells you that if you were insuring this risk for that very long period of time, this is the minimum amount of premium you would need to collect over this period of time to break even with the losses that you would expect from tropical cyclones. Now, of course, this is just covering the risk. Insurance and reinsurance policies also have different loads for cost of doing business, profit loads, etc. So that's not at exactly what you're going to pay for coverage, but if you just want a pure up metric of what your long-term risk is to tropical cyclones or any peril, the AAL is it. It is calculated by summing up the mean losses by event rate for all the events in the stochastic event set, and graphically, the ground-up AAL is represented by the area under the aggregate exceedance probability curve as shown here. The hatched area would be the area of this. However, if a policy is occurrence-based, like many reinsurance catastrophe excess treaties, the AAL is based on the OEP curve. So say we had an occurrence-based reinsurance policy providing $10 million of coverage in excess of $10 million. So this is the policy attaches at $10 million of loss and covers the next $10 million up to $20 million. So the AAL for this policy for tropical cyclone would just be the OEP curve, the finite integral of the OEP curve from 10 million to 20 million. So if you just remember your basic calculus, that's how you come up with the metric. And down here in the lower left is just a quick example of AAL. I think you guys will figure that out. So up until this point, I really have not touched anything about model uncertainty. And obviously, there is a tremendous amount of uncertainty in these models in every component, from the event set development all the way down through the financial modeling. So there are several levels of uncertainty that we talk about in regard to CAT models. First is the primary uncertainty, which is really the uncertainty in the likelihood that a particular event occurs. And usually within the modeling world, this is represented by the event rate and the mean loss expected at a given location. So this is asking, what is the uncertainty or probability that a Category 5 will pass directly over downtown Miami? And if so, what are the expected losses associated with that? That is the primary uncertainty. But even if we know we're going to have an event landfall, there's still a lot of uncertainty around what the financial impacts of that landfall are going to be. And we call this type of uncertainty secondary uncertainty. This is, given that a certain event has occurred, what is the uncertainty and the losses that we expect? And this is really represented by the variation around the mean event loss. And the sources of secondary uncertainty are many. There's uncertainty within the hazard itself, the size and the shape of the wind field, terrain effects, so on and so forth. Filling effects as well. Vulnerability uncertainty has many. There's a range of possible damage states. And there's a few other examples as well. You can run the model both with and without secondary uncertainty. If you're only using the mean losses, we call this an expected loss methodology. So here you see a primary layer with a deductible, what the layer covers in excess. And if you model with an expected methodology, the model for a given event will only produce this mean loss, which in this case means that the client is paying the deductible and gets a partial payout. But if you're incorporating the secondary uncertainty into the model, you get what we call a distributed loss methodology, which means the model is considering both this mean loss, but a probability distribution around this loss. So if you're using the distributed mode, you still have the same mean loss. However, there is a non-zero probability that this event could cause a loss to this risk in excess of the primary layer and cause a loss. Or it could even be below the deductible and there's no payout by the insurer. So this distributed methodology allows for a more fluid, multiple solutions to what might actually happen to an individual risk or portfolio risk, and gives you a larger range of potential solutions or outcomes, and likely gives a more robust answer. Now, EP curves, I just said that, so I'm going to skip that. If you don't include the secondary uncertainty, EP curves often look like step functions, like you see here. And also, the EP curve losses can't exceed the greatest mean loss from a single event for OEP or in a calendar year for AEP. However, once you incorporate that secondary uncertainty, the curves tend to be much more smoother, because in the case where there's no secondary uncertainty, really almost every point is just on the EP curve is informed by one event and whatever expected loss it is and where it fits on the EP curve. With secondary uncertainty, you can have hundreds to thousands of different events in the event set informing the probability of exceedance of a given loss point. Because of these distributions, you might have many events informing that could cause that level of loss. And also this allows, the secondary uncertainty allows the EP curve to be extended much beyond the largest mean loss that's output and can give you a more robust tail distribution, which is really important. Cat risk modeling is really largely much more concerned with the rare, more extreme events in the tail than the more frequent events at the beginning of the EP curve. So, cat model limitations, I'm already at 75 minutes, so I really will just leave this up for reading. This is, we can go back through this in the Q&A period, but I have some issues. In red are some questions about the data you put in, green on the hazard and intensity component of the models, blue for vulnerability, and purple for financial. And this is no way near exhaustive. I could probably give full-day presentations on almost each of these separate areas. But you can see there's a lot of areas that are still uncertain in the models, and that a lot of research over the next few decades is going to continue to prove and hopefully start to reduce this list going forward. And maybe that's a topic that will be the theme of some of your careers once you get out of college. Lastly, I'm going to just mention a couple of things to remember. CAP models are not exact. They are always wrong, and they will always change. I remember what I was told when I was at Florida State is, don't forget the difference between a model and reality. So models will never be right, but we can get them to a point where they can provide useful information to inform business decisions. So always keep that in mind. They provide a consistent way to monitor exposures and loss potentials from catastrophic events. Even though these models typically on the peril and hazard side have very similar data foundations, these are very complex probabilistic tools based on a combination of science, engineering, and expert judgment. Expert judgment could also be known as educated guessing. In some cases, I'd just even take the expert off and say it is a guess. And so that's why none of these models are right, and you have to understand the assumptions that go into these models to make intelligent decisions based upon their output. Some people in the industry think models replace underwriting. It does not. Models are just another tool to help inform and support the underwriting process. They give more information than any other time in the past to trying to write these types of catastrophic risks. These models are now ingrained within the industry, and they're calibrated to reflect the financial risk. So remember the end result here. We don't need really high resolution models that within, cat models. We don't need ECM WF level detail going into these. What we're really after is refinement of this. So let's not worry about too much precision, because there's so much uncertainty that it's almost lost in the uncertainty by going too precise. Same thing with the financial outputs. These models will output financial results down to the penny. Remember, and you could have results down to the penny, but you can have standard deviations in the millions of dollars. So, just take the results with a grain of thought and realize they are rough estimates. So these tools are essential in the industry. The good news is demand for geoscientists who can either build, assess, interpret, perform analytics on these models, and particularly those who can communicate clearly and effectively on these topics are increasing demand, and definitely a good area to look for potential employment once you graduate with your degrees from Penn State. So with that, I know that's a lot of information, not much time for questions, but I would be happy to get to everyone's questions online or offline as needed. My email is up there, my Twitter handle. I tweet regularly on NatCat and insurance-related issues, so feel free to follow me if you do that. And with that, thank you very much for your attention, and I look forward to all the feedback and questions you have. Thank you.
Excellent. Thank you so much, Mark. And yeah, incredible presentation. Just to make everyone aware, because we always get this question, we will make sure we have the presentation, the slideshow itself, and then also a recording of today's webinar available on the Weather Risk Alumni Society website. That's psuvrisk.alumni.org. So that's where you can go. And then I know the ISCM will also have be making this presentation recording and the slides available as well. So if you have friends or family who didn't have a chance to check in this afternoon and are interested in seeing the presentation, we'll make sure to make that available. Let's dive right in. We have 14 minutes. Got a few questions for you, Mark, from our audience. The first one is related to the vulnerability module. And the question is, are vulnerability relationships non-parametric functions, or are we always fitting a parametric relationship to the data? So that's the first part of the question. So yeah, vulnerability functions, are they non-parametric, or are we trying to ultimately fit that data to a parametric function?
I think that would depend on the model in question. I think there are multiple approaches that could be seen as legitimate. Now, I mentioned this is a highly idealized vulnerability curve. In reality, you'll see a lot of clustering around zero around the x-axis and y. But one of the things you'll notice is, to calibrate these curves are mostly based on empirical data from claims and some from engineering studies. But, before this year, with really the landfall of Harvey being the first and Irma being the first Cat 4 landfalls in quite some time, we have very limited data up in this higher end of the curve. So there's a couple of issues here. So once in a while, most modelers will use the empirical data to try to fit the lower end of the curve. Then they might have some kind of discontinuity or jump or smooth it out via parametric curve to make assumptions here at the top end. And obviously it's going to asymptote once it gets to 1, because you can't get beyond complete damage. And in fact, for some types of coverages, once you get to a damage factor of about 60 to 70%, in reality, that level of damage might be adjusted by a claims agent as a total loss. So in that case, you actually have a step function right up to 1 at a certain point. I would say the parametric fitting is okay. I would rather follow the data where it lies. But also, one of the other key issues here is there's so much uncertainty in this middle part of the curve where we have data, both with the wind, what was the actual wind gust at the location that caused the damage, and then what, given a certain wind speed, what the damage states can be. So there's a lot of uncertainty there that also needs to be considered, that's taken care of by the secondary uncertainty. So in short, I think you could do it either way, follow the data, but usually some kind of fudging needs to be done, particularly at the high end of the curves due to lack of data. Also, for less common construction and occupancy, there are fewer claims data where expert judgment needs to fill in the gaps.
Okay, great. And just a follow-up, since we're on the topic of vulnerability curves, in the defining, and I did my best to ask this individual to clarify a little bit, because the initial question had to do with vector valued intensity measures. And I think really what they're trying to understand is, in the chart we're seeing here, mean damage factor on the y-axis and maximum wind gust on the x. Imagine for the hail peril as an example, you're going to have potentially multiple variables that make up that mean damage factor. It might be both the size of the hailstone and the wind speed. So in a peril like severe convective storm, severe thunderstorm, where you're talking about multiple perils and the correlations between those perils, are the models able to take into account in the vulnerability function multiple intensity measures to define this distribution for the mean damage loss?
The short answer is yes. Different modelers can take different approaches based on what claims data and knowledge about the historical events that they have to try to calibrate. Ultimately, they can calibrate to whatever metric they want. Some just due to lack of data, or they just don't trust information on hail size, hail density, or like hail impact energy, they might just go ahead and use a rough hail size as the function. Is that really correct? But in some cases, that might be the only data you have, and you calibrate towards the data you have. Some modelers, will go a little further, say, okay, what is the distribution of hail sizes within a hailstorm? What is the density per square meter, square kilometer of hailstones? What are the wind speeds co-located, because it'll add extra momentum and damage factors, and they can include those as factors as well. The thing I do caution is the more you parse down either the historical data on which these are calibrated or the claims on which these curves are calibrated, you start losing, all of these are based on the law of large numbers, and the more you subset them down into different constructions, occupancies, or even parse the hazard down into, okay, 3-inch hail, but with wind of 60 miles per hour, 3-inch hail with 40 miles per hour, you get much fewer and farther between, and the uncertainty increases. So I would say, yes, they should consider what the questioner said, but of course, if it gets down to the point where you can't really make good assumptions or decisions based on it, you might have to go to a more broader general metric.
Great. Thanks, Mark. So another question here. This has to do with more of the, combination of the vulnerability functions, but also the financial module piece. The question was, is the ground up loss result always proportional to the insured value of the risk? So our ground up loss is always proportional to the TIV based on this mean damage factor function, A, and B, are there other alternatives that are used outside of just these damage factors?
Okay, let me answer the first. I really think by definition, the ground up loss can't be more than what the policy covers. It is not necessarily proportional with the intensity. Obviously, the curves are more like this. Once you get past a certain wind intensity, you hit an inflection point, and the damage factor increases much quicker. So, your ground up losses, if the max wind speed at your house was 80 miles per hour as compared to the max gust was 120, is going to be vastly different. Can you repeat the second half of that question again?
Yeah. Well, so really so I think you covered the first half. The second half was really, are there alternatives to using damage factors? And I don't think there are. I think it's really it's a function of what obviously the value of the particular risk is that they're being applied to.
It is. I would say this is the standard way the industry does it. Some modelers will give you some sensitivity testing around these curves. They might give you higher and lower vulnerability bounds, maybe based on like 1 sigma from the mean of these curves, so you can sensitivity test. And that is one of my key roles here at Munich Re America, is doing these sensitivity tests. And if we find that we feel one of these curves is severely underrepresenting losses we see in reality, we might say, okay, for operational purposes, let's use the higher vulnerability curve. But overall, these, I would say, I agree, are fairly standard and used consistently throughout the industry.
So we have another question here. This has to do with hazard module. So hazard for hurricanes. And the question here starts with a statement. This individual's heard that the sample size provided by all hurricanes in recorded history is not big enough to use the law of large numbers, right? Only have 150 years basically of hurricane data, and only probably 50 years that's as useful as we'd like it to be. So the question is, how do the models account for this in the event set? So it's really, how do they use the historical data set, well, because we know it's limited, to synthetically generate tens of thousands of years of events?
That is an excellent question and could take up a full other day of presentation. So in a couple of minutes, basically they are using HERDAT and BestTrack to inform. Now, yes, you probably have 10 TCs on average per year, 150 years, so about 1,500 in the historical record. They, even if a storm doesn't make landfall, they'll take metrics from it to understand the overall movement. But yes, really the key here is that the models, I don't want to say have to, but there is an industry and government expectation that what these models are going to produce is representative to what at least we've seen in the historical record over the past 150 years. As I mentioned, the state of Florida regulates these models for rate-making considerations. They have to be approved, and Florida requires them to use the long-term historical rates based on the empirical data record from at least 1900 on. Of course, the 1851 to 1900 in Florida, due to the lack of population, except for mosquitoes, is probably not complete. But the government is basically saying, you can't really, you can produce other views of risk, but for real operational purposes, they're only using the long term, and that's what the modelers are calibrating. And of course, there are gaps. There's no direct hurricane landfalls in Georgia since the 19th century. So the modelers have to fill in these gaps with assumptions and expert opinion. For the example of Georgia, they might look at bypassing storms like Matthew and say, okay, if Matthew was just a few miles further west, it would have brushed the Georgia coast. They will look at bypassing storms in the Keys, off of Cape Hatteras, off of Cape Cod, to inform these are lower frequency areas. But ultimately, they are not changing what we see in history. Otherwise, they probably would not be able to do the amount of business they need. So we are making a general assumption of stationarity of the perils. Whether that is a good assumption or it's complete enough, those are excellent questions. And I think would have to be debated at a different venue for a much longer time.
Thanks, Mark. And we have, so in the 3 minutes remaining, we have 2 questions. I'm saving the first that came in actually until last, because it's a more high-level question. I'd love to get your thoughts, Mark. But the first one here comes in the form of asking really about how can we better customize CAT modeling, and would a complete list of addressable locations help in customized CAT modeling? So right now, obviously, it's very portfolio-based. I think I know some of the answer to this, but would like to get your thoughts. Having a complete list of addressable locations, would that help customize CAT modeling?
Well, the complete list of address locations, that would be another geospatial hazard database, or another one that future models might consider. The models already, if you don't have all your exact information, if you don't know if a house is wood frame or masonry, what the models typically do is they select a composite vulnerability curve based on the industry, the makeup of standard homes within the postcode or county where your risk is located. So say if you're in South Florida, most homes have masonry walls with a wood frame roof, but if you put in unknown for Miami-Dade County for a single family dwelling, it's likely going to produce a curve that closely reflects, because most of the homes are built like that. I ultimately think having almost industry parcel database, so to speak, would be useful in many ways. Though I'm not sure, would be very difficult to fully compile, and ultimately, I'm not sure, given the amount of data, how much operational benefit or efficiency you'll get. But from my experiences on site after Hurricane Irma this year, when seeing that how well the wind codes in Florida held up to Irma, particularly in the Keys to newer construction, I would say, one of the things I observed is that, in gated communities in Florida that were built recently, that all are built to the newer construction, barely had scratches on it. However, newer construction that performed relatively well, but was in mixed neighborhoods of different, with different ages of construction around it, we tended to see more. So I almost view this as quote unquote herd immunity for our communities. I think, if every home in a community was built in 2012 to the best building codes in the country, wind building codes in the country, the losses would be much less than if you have a home built in 2012 next to a home built before post-Andrew codes were in effect in Florida. So I think there is some benefit to be gained, because like herd immunity for vaccines like measles, you need to have a certain percentage immune before it doesn't really transmit within the population. I think similarly, a little extra information can tell us whether what is the surroundings around your house, but also if you have poorer risk around you, and that might ultimately change things going forward. But once again, with just the sheer size and logistics, I'm not sure the benefit is quite there.
So final question for you, Mark. In your opinion, what is the future of cat risk modeling?
Excellent question. I have been in this field for 17 years now, and it continually evolves. What I think we're going to see is we're seeing models already start moving away from this purely statistical approach. We're seeing increases in using the NWP technology to create event sense and then fill in the gaps and inform these models where they don't occur. From the operational perspective, these models are going to become more and more that you never even interact or work with the data itself. You just get the data from a client. It gets imported directly into an internal system or a model. It gets run, and you get the results and send them along their way. Now, that being said, so today there are a lot of positions in the industry for people to work with the data, run the model, et cetera. That is going to be shifting from less to being running the model itself to analyzing the output. Looking at the exposure, linking it up with the actual loss of the model outputs, and creating analytics around that, giving the analytics that can help explain to the underwriter or the person writing the business why you're getting the results that you are. You can speak to the uncertainty about it. You can talk to whether you feel that this is actually realistic, or if you feel that the model is producing unlikely results. So it's going to be more from an operational at the insurer and reinsurer to more interpreting and doing the analytics around the loss results. Also, from the model generation, we're seeing that we're moving away from a mean loss methodology of creating these events. So right now in a lot of these statistical models, for an event, you'll always get the same mean loss for a risk of the same location. If you run the model 100 times with the same location, same risk, you're always going to get that same mean loss. In reality, if a same TC went over your house 100 times, you probably have a number of different damage states. And what we're going to see in the future is more of this actual sampling of the event set and sampling from the distributions of damage, of vulnerability, to get different levels of loss and get a different way to converge the results of these models. So I think between that and the continual expansion and detail of these models, not just for North American perils, but perils globally, mean there's going to be a lot of high demand for work in these fields. And I think the role of meteorologists in interpreting and creating these data will only become more important with time.
Excellent. Well, thank you so much, Mark. Really appreciate your time and energy this afternoon. Great presentation. We answered a lot of really good questions that came in. I personally want to thank everybody who attended this afternoon for the webinar. Really appreciate your time. Hopefully you learned something today. Again, we will have the presentation and a recording of today's webinar available for you on both the Weather Risk Alumni Society's website and then also through the ISCM. So however you found your way to today's webinar, we'll make sure we have those resources available for you. Mark had put up his contact information on the last slide. He can be found on Twitter. You can shoot him an email if you have any follow-up questions for Mark or myself. Feel free to reach out to us. But again, thank you everyone for your time and attention. And we'll hopefully catch you at the next, the last part of our webinar series, which is scheduled for Wednesday, December 13th. That'll be at noon Eastern time. And we'll be sure to have more information about registering for the final part of our series within the coming weeks. So thanks again, everybody. Enjoy the rest of your day.